Her name was Alina Papadopoulos. She was 43 years old, a pharmacist from Thessaloniki, and by almost any measure, she had built a responsible life. She owned a modest apartment outright. She had a savings account at a bank she had trusted for 18 years, with just over 22,000 in it money set aside for her daughter's university, for the kind of contingency that people who think ahead always prepare for. She paid her taxes. She had never missed a rent payment, never carried credit card debt, never made a bet she couldn't afford to lose. She was not wealthy, but she was stable. She was the person the financial system was designed to serve. On the morning of Saturday, June 27, 2015, the Greek government announced that banks would close the following Monday. App withdrawals would be capped at €60 per day. Transfers abroad were suspended. The stock exchange was shuttered. Alina had about €40 in her wallet. She had done everything right. She had followed every rule society had given her. She had no idea that within 72 hours, everything she trusted would collapse. We tend to think that financial security is about accumulation, how much you save, how faithfully you contribute, how carefully you choose your assets. But the crisis that froze Alina's savings wasn't about the amount she had saved. It was about where she had put it, and what invisible conditions that location depended on. The real question was never how much is in your account. The real question was who controls access to it, under what conditions, and what happens when those conditions change. Most people never ask that question until it's too late. The architecture of financial safety is not what it appears, and the mechanisms that turn a normal savings account into a locked box are not exotic or theoretical. They are documented, precedented, and written into law. Today we're going to perform an autopsy, not on the event itself, but on the systems that failed inside it. To understand what happened to Alina and why it has happened to millions of people across dozens of countries, you need to understand the world they lived in and why it felt so safe. For most of the post-war era, the banking system in developed economies operated with a reasonable social contract. You deposit money, the bank safeguards it, and you can retrieve it on demand. Central banks acted as backstops. Deposit insurance schemes gave ordinary savers a formal guarantee up to a defined limit. The system had survived recessions, currency shocks, and market crashes. It was, by the standards of living memory, profoundly stable. That stability built a very understandable assumption that your money in the bank was your money, that the account balance on your screen was a direct representation of accessible, retrievable cash, that the system, whatever its flaws, would always function at the level of the individual depositor. The structural flaw in that assumption was not about fraud or mismanagement. It was simpler than that. It was about the fact that banks do not hold your deposits in a vault. They lend them out. Your savings become someone else's mortgage, someone else's business loan, someone else's leveraged bet. The bank owes you money, but it only keeps a fraction of it available at any given time. The entire edifice, the insurance, the central bank backstop, the regulation exists to manage the gap between what is owed and what is on hand. The system works as long as nobody asks for it all at once. Chapter 1. The bank account. People believed their bank accounts were storage, a safe place where money sat, waiting, unchanged, until they needed it. The phrase keeping money in the bank implied exactly that, a kind of custodial arrangement, like a safety deposit box, but for cash. That belief was reasonable. It was also incomplete in a way that only becomes visible under stress. A bank account is not storage. It is a loan. When you deposit money into a commercial bank, you become an unsecured creditor. The bank owes you that sum with interest, but it has lent the majority of it out at a higher rate, keeping only what regulation requires in reserve. In a normal environment, this works invisibly. Bank manages its liquidity across millions of customers, and the probability that everyone asks for their money simultaneously is, statistically, remote. Until it isn't. In Greece, by mid-2015, the mathematics had shifted. The Greek government was in the final, failing rounds of bailout negotiations with European creditors. The EP, the European Central Bank, was providing emergency liquidity to Greek banks to keep them functional. When negotiations broke down on Saturday, June 27, the EP announced it would not increase that emergency funding. Without a continuous injection of central bank support, Greek banks would not survive a business day of normal operations. The government had one option: close the banks before Monday morning and impose strict capital controls. Alina went to the ATM on Sunday evening. She joined a queue that stretched around the block. By the time she reached the machine, it was out of cash. The limit, when machines were finally restocked, was €60 per day. Not €60 beyond what she'd already spent. €60 total per day. For a family paying rent, buying groceries, filling a car with petrol, and managing any kind of unexpected expense. €60 was a constraint that shifted from inconvenient to suffocating within days. Pensioners queued for hours to collect a weekly pension capped at $120. Businesses could not pay foreign suppliers. The restriction lasted, in various forms, for 4 years. Capital controls were not fully lifted until September 2019. The structural flaw here was not Greek incompetence or European cruelty. It was something more fundamental. A bank account's accessibility is not a property of the account itself. It is a property of the system surrounding the account. Remove the system, the liquidity support, the political stability, the depositor confidence, and the account ceases to function. The number on the screen remains. The cash does not. This is the trap. Your bank account gives you a claim on money, not money itself. You might say that was specific to Greece, a small economy with a sovereign debt crisis and no independent central bank. But the structural lesson remains: every deposit account in every country is only as accessible as the political and financial infrastructure surrounding it permits. Chapter 2, the physical cash reserve. And yet people who did have cash on hand survived those weeks far better than those who didn't. Which brings us to a different kind of failure, not a systemic one, but a personal one. The failure to hold any meaningful portion of savings outside the banking system. Physical cash in a secure location at home or in a private safe is not a relic of the banking era. It is a functional hedge against exactly the kind of short circuit that Alina experienced: the gap between the moment a system freezes and the moment it unfreezes, days or weeks later. But most people in the modern economy hold almost no physical cash. In 2015, the average Greek household held approximately €500 to €800 in cash, 2 to 3 weeks of basic expenses. That was, as it turned out, roughly the buffer needed to survive the initial banking closure without crisis level hardship. The argument against holding physical cash is straightforward: it earns nothing, it can be stolen, and large amounts trigger legal and tax scrutiny. All of those arguments are real. None of them invalidate the core utility of cash in a liquidity crisis. In Cyprus in March 2013, banks were closed for nearly 2 weeks before capital controls were announced, limiting withdrawals to 300 per day per institution. People who had meaningful cash reserves at home maintained normal lives. Those who didn't faced genuine hardship in meeting basic obligations. The structural logic is simple. Cash held outside a bank is not subject to withdrawal restrictions. A bank can limit your access to a deposit. It cannot limit your access to a banknote in your kitchen drawer. Alina had €40 in her wallet when the announcement came. For the first 3 days, before her local pharmacist arranged an informal mutual credit system with regular customers, those €40 were the entirety of her liquid world. This is the trap. Physical cash has no counterparty. Its risks are physical, not systemic, and in a systemic crisis, that distinction is everything. You might say that cash at home is the approach of people who distrust banks, a fringe position. But the structural lesson remains: a modest physical cash reserve is not a statement of ideology. It is insurance against the gap between system failure and system recovery. Chapter 3 U.S. Treasury securities held directly. The third failure mode is more subtle and more relevant to savers in larger, more stable economies. It concerns what happens when a crisis is not a sovereign collapse, but a banking sector stress event, and where exactly your money needs to be positioned to remain accessible during that stress. In the United States, the standard advice for liquid savings has long been keep it in a FDIC, insured bank account, up to the $250,000 limit. That advice is not wrong, but it contains a hidden dependency. FDIC insurance is an insurance fund, not a real time guarantee. As of the most recent public figures, the FDIC's deposit insurance fund holds approximately $128 billion. Total insured deposits in the U.S. banking system run into the tens of trillions. The fund is designed to handle isolated bank failures, not simultaneous systemic stress. This is where U.S. Treasury securities, purchased directly through Treasury Direct Gov, represent a structurally different position. When you hold a Treasury bill, a Treasury note, or an I-bond in a Treasury Direct account, you are a direct creditor of the U.S. federal government, not an unsecured depositor in a commercial bank. The account is held by the Treasury, not by a bank. No banking intermediary stands between you and the obligation. This matters for a specific and limited reason. In a scenario where multiple banks face simultaneous stress, not an impossibility, as 2008 and the March 2023 regional bank failures demonstrated, commercial bank deposits become subject to the mechanics of bank resolution. Under Title I of the Dodd-Frank Act, in a resolution scenario, deposits above the $250,000 FDIC insurance threshold are classified as unsecured claims. Treasury securities are not bank deposits. They are not subject to the same resolution mechanics. In Argentina, in December 2001, the government froze all bank accounts and imposed what became known as the Corralito cage. Withdrawals were limited initially to 250 Argentine pesos per week, at a time when the peso traded at parity with the U.S. dollar. Simultaneously, the government converted all private pensions into Argentine Treasury notes. Savers who held government bonds in brokerage accounts outside the domestic banking system retained more flexibility than those whose assets were locked inside frozen bank accounts, though Argentine sovereign bonds ultimately defaulted as well. Elena, in Thessaloniki, had no treasury securities. Everything she had was in the one institution that had just closed. This is the trap. When you hold savings inside a bank, your counterparty is the bank and the bank's continued access to the system that supports it. Treasury securities held directly put your counterparty one level higher up the institutional chain. You might say that treasuries are subject to political risk in ways a bank account is not. But the structural lesson remains: the question is not which counterparty is perfectly safe, none are, but which dependency chain is shorter. Chapter 4: Precious metals physical, held outside the banking system. Now we arrive at the asset class that generates the most disagreement and the most misunderstanding. Physical gold and silver, held in personal possession or in a private vault outside the banking system. The standard case against gold is economic. It produces no yield, its price is volatile, and sophisticated investors have better tools. Every one of those arguments is valid in a functioning system. None of them address the specific utility of physical precious metals in a systemic breakdown. In Cyprus in 2013, the bailout terms imposed by the Troika, the ECB, the European Commission, and the IMF included a bail-in of large depositors at the island's two largest banks. Deposits above 100,000 at Laiki Bank and the Bank of Cyprus were subjected to a levy. At Laiki, large depositors lost essentially everything above the insured threshold. At the Bank of Cyprus, approximately 47,000 5 of deposits above 100,000 were converted into bank equity, not withdrawn, converted, into shares of a bank that had just been restructured. The money became paper in an institution that the depositors had never chosen to invest in. People who held physical gold during that period held something that no decree could convert. The price of gold in euros rose approximately 6 between January and March 2013 as the Cypriot crisis escalated. It was not a windfall, it was a floor. A gold coin in a private safe does not appear on any bank balance sheet. It is not subject to bail-in, withdrawal limits, or capital controls, because it is not inside the system being controlled. The risks a real physical gold can be stolen. It is illiquid in small quantities, and carrying it across borders triggers customs scrutiny. It also requires secure storage, which has its own costs. These are not trivial concerns, but the structural fact remains. The 2008 financial crisis saw gold prices rise from approximately $70.50 per ounce in October 2008 to over $1,000 by February 2009, not because gold was profitable in a traditional sense, but because capital fled from bank-dependent assets toward instruments that existed outside institutional counterparty chains. Elena owned a gold necklace and 2 small gold rings, gifts from her mother. She did not sell them during the crisis, but she understood, afterward, what they represented, that her savings account did not value without a counterparty. This is the trap. An asset inside the banking system is always subject to the rules the banking system operates under, rules that can change overnight. You might say that physical gold is impractical as a primary savings vehicle, but the structural lesson remains a modest allocation to physical precious metals held outside the banking system is not speculation, it is a position in an asset class that has no institutional dependency. Chapter 5: Foreign Currency Accounts and Multi-Jurisdictional Diversification. The 5th failure mode is geographic concentration. Elena held all of her savings in one country, denominated in one currency, inside one banking system, and when that system froze, she had no alternative source of liquidity in any other jurisdiction. This is not a problem unique to peripheral Eurozone countries. In Argentina's 2001 Corralito, not only were peso accounts frozen, but dollar-denominated accounts inside Argentine banks were also restricted. The Corralito captured accounts regardless of currency because the control was over the banking infrastructure itself, the physical and legal apparatus of the domestic banking system, not merely the currency. People who held accounts in foreign banks, particularly in Uruguayan or US institutions, maintained access to those funds throughout the Argentine crisis. The accounts were beyond the reach of the Argentine government's freeze because they were not on Argentine balance sheets. The structural logic here is straightforward. A government can impose capital controls on every bank within its jurisdiction. It has no authority over banks in foreign jurisdictions. A depositor with a small account in a stable foreign bank in Switzerland, Singapore, or the United States maintains at least partial liquidity, even if their domestic accounts are frozen. The practical barriers are real foreign bank accounts require minimum deposits, often involve tax reporting obligations, and carry currency exchange risk. For most middle-class savers, a full multi-jurisdictional banking strategy is operationally complex. But a modest position, a savings account in a foreign bank, maintained as a liquidity reserve rather than an investment, is a fundamentally different structure from keeping everything inside one domestic system. This is the trap. Geographic concentration in savings is not diversification. It is exposure to the rules of a single jurisdiction. You might say that multi-jurisdictional banking is for the wealthy or for the paranoid, but the structural lesson remains in a capital control event. Access to funds in a foreign jurisdiction is the difference between illiquidity and function. Chapter 6: Brokerage held assets outside the banking system proper, the final mechanism, is the most nuanced and perhaps the most relevant to the audience most likely to be watching this. A brokerage account at a firm such as Fidelity, Schwab, or Vanguard is not a bank account. This distinction matters enormously in a banking-specific stress event. Bank deposits are liabilities of the bank. Brokerage assets, stocks, bonds, F's money market funds are not liabilities of the brokerage. They are assets held in custody for the client. If the brokerage fails, SIPC insurance covers up to $500,000 in securities per account. More importantly, securities held in brokerage accounts are legally segregated from the brokerage's own balance sheet in ways that bank deposits are not. A money market fund held in a brokerage account is not the same as a savings account at a bank. A short-term bond F is not a deposit. In a scenario where banking sector stress creates withdrawal restrictions on bank accounts, brokerage accounts holding securities may remain accessible not because they are perfectly safe, but because they are structurally outside the bank resolution framework. The caveat is critical. In severe systemic events 2008, level stress money market funds themselves came under pressure. In September 2008, the Reserve Primary Fund broke the buck, falling below a 1 net asset value due to exposure to Lehman Brothers commercial paper. The government had to backstop the entire money market fund industry to prevent a run. So brokerage-held assets are not immune to systemic events. They are structurally differentiated from bank deposits, a meaningful but not absolute distinction. Alina had no brokerage account. The structure of Greek household savings, then as now, concentrated heavily in bank deposits. When the banks closed, the household balance sheet simply stopped functioning. This is the trap. Holding all liquid savings as bank deposits means your liquidity depends entirely on the continued functioning of the banking system. A brokerage account introduces structural separation, incomplete, but real. You might say that maintaining two separate financial structures is needless complexity during normal times. But the structural lesson remains in a banking-specific crisis. Structural separation is the only kind that matters. What connects all 6 failure modes is not their surface features. Each looked different: a frozen savings account in Greece, a confiscated deposit in Cyprus, a corralito in Argentina, a failed thrift in Pasadena, a bail in Nicosia. Different countries, different mechanisms, different legal frameworks, different scales, but underneath them all ran the same dependency. Every one of these assets, bank deposits, pension funds, even certain money market funds, depended on the continued functioning of the institutional credit system. That system is not a single thing. It is a network: commercial banks, central banks, interbank lending markets, government guarantees, deposit insurance funds, and political will. Each node in the network depends on the others, and the entire network depends on one thing above everything else: confidence. When confidence in any major node begins to erode, the network does not fail slowly. It fails at the speed of information. A bank run in the digital age takes hours, not days. Contagion spreads across institutions before regulators can construct a response. The mathematical cascade begins, and it is largely self-reinforcing once it starts. This is the meta lesson that most financial advice misses. Diversification across asset classes: stocks, bonds, real estate, cash is not the same as diversification across dependencies. If all of your assets require the continued functioning of the same institutional credit network, then you have not diversified your risk. You have allocated it differently within the same dependency. The only genuine diversification against institutional credit risk is partial exposure to assets that exist outside the institutional credit network: physical cash, physical metals, foreign accounts, Treasury securities held directly by the government rather than through a bank. None of these are substitutes for a complete financial plan. But they are the difference between partial resilience and total vulnerability when the network itself comes under stress. It would be incomplete to perform this autopsy without naming who emerged from these crises in better condition. In Greece, the entity that effectively controlled the crisis was the European Central Bank. The ECB held the decision over whether to continue emergency liquidity assistance to Greek banks, a decision it made and then withheld based on the status of bailout negotiations. Institutional creditors of the Greek government, largely large European banks, insurance companies, and the ECB itself had already been partially protected in the 2012 restructuring, which imposed losses primarily on private bondholders rather than official creditors. In Cyprus, the banks that survived the crisis were smaller institutions that had not participated in the Greek sovereign debt exposure. Investors who held positions in restructured Cypriot bank equity at distressed prices after the bail-in had already decimated large depositors, acquired stakes at pennies on the dollar relative to their eventual value. The mechanism of bail-in transferred ownership of the banking system from depositors to new equity holders. In Argentina, the entities with access to foreign banks and dollar-denominated accounts abroad preserved their wealth across the devaluation. When the peso was unpegged from the dollar in early 2002 and the exchange rate moved from 1:1 to approximately 3:1, those holding dollar assets abroad saw their relative wealth triple in peso terms. In all of these cases, the pattern was the same. Institutional investors, sophisticated creditors, and those with existing access to assets outside the domestic banking system were structurally positioned to preserve, and in some cases, expand their wealth. Ordinary depositors, people like Elena, absorbed the losses that made the system's survival possible. This is not a conspiracy, it is a structural outcome. The system was designed with one logic during normal times and a different logic during crisis. Most people only discover the second logic when the crisis is already underway. Could these crises have been prevented? In each case, the honest answer is partially at the margins with different policy decisions. Greece could have accepted an earlier, less punishing bailout. Argentina could have abandoned its dollar peg before the pressure became catastrophic. Cyprus could have regulated its banking sector's exposure to Greek sovereign debt earlier. But the deeper question is not whether a specific outcome could have been avoided. It is whether a system with this architecture can ever be made permanently stable. The mathematical structure of modern banking creates a kind of permanent latent fragility. Banks borrow short and lend long. They take deposits that are redeemable on demand and make loans that mature over years. The gap between those timelines can only be bridged by the steady, uninterrupted flow of new deposits and interbank borrowing. If that flow stops, the gap becomes visible instantly, and the moment it becomes visible, depositors who perceive the risk begin to withdraw, creating the very shortage they feared. The run is the crisis, but the potential for the run was always embedded in the structure. Deposit insurance and central bank backstops are designed to interrupt that feedback loop. They work well for isolated failures. For systemic events where the institutional credit network itself is under stress, the backstops depend on the same confidence that is already failing. The FDIC fund is not large enough to handle a simultaneous multi-bank failure without extraordinary government action. The EP's emergency liquidity assistance was a political decision, not a mechanical guarantee. The system was built on confidence, and no system built on confidence can survive indefinitely if the conditions that create that confidence are removed simultaneously across multiple nodes. This is not a modern phenomenon. In 1931, an Austrian bank called Creditanstalt failed. It was the most important bank in Central Europe. Its failure triggered a cascade of bank runs across Germany, Hungary, and Czechoslovakia, ultimately pulling the global banking system into the deepest phase of the Great Depression. Ordinary depositors in Vienna, Budapest, and Berlin had done nothing wrong. They were simply inside a system that failed at a scale that overwhelmed its own safeguards. In 1988, Brazilian bank depositors woke to find that the Sarney government had frozen all savings and checking accounts above a minimal threshold as part of an emergency inflation control program called the Plano Bressa, overnight, with no advance notice. In 2013, Cypriot savers with deposits above $100,000 were subjected to the first explicit bail in the Eurozone's history. The mechanism was new. The effect ordinary savers absorbing losses to preserve the system was not. In 2019, Lebanese banks informally restricted dollar withdrawals to 1,000 per week, then tightened further as the crisis deepened, with foreign currency withdrawals to 200-300 per week. By 2021, dollar withdrawals from accounts opened before October 2019 were functionally impossible, with any permitted withdrawals converted to Lebanese lira at a rate that represented a loss of over 70% of market value. The names change. The mechanisms differ. The underlying structure is the same. Today's systems are not fundamentally different. They are larger, more regulated, more insured, but they still depend on the same institutional confidence that has failed in documented historical record dozens of times across 6 continents. Alina resumed her life in Thessaloniki. The capital controls loosened in stages over the following months, and by 2019, they had been fully lifted. She recovered access to her savings. She did not lose the principal, which made her luckier than many Cypriots had been 6 years earlier. But she spent 2 years in a condition she had never anticipated and had made no provision for being unable to freely access money. That was, by every legal standard, hers. She told a journalist in 2016 that the experience had not made her distrust banks. It had made her distrust the assumption that banks always work. That is a more precise and more useful insight than the first. The lesson this autopsy produces is not put your money somewhere else. Every alternative discussed in this script has its own risks, its own dependencies, its own failure modes. Physical cash can be stolen. Precious metals can be confiscated. The United States did exactly that in 1933, under Executive Order 6102. Foreign banks operate under foreign laws. Treasury securities are obligations of a sovereign whose own fiscal position is not without risk. The lesson is this: before you trust an asset with your financial security, ask yourself one question. What institutional infrastructure does this asset depend on to remain accessible? And what happens to my access if that infrastructure is stressed? Ask it about every savings account. Ask it about every pension. Ask it about every brokerage account. Not to find a perfect answer, there isn't one, but to understand the dependency clearly before you need to. Alina stood at that AM on a Sunday evening in late June 2015, certain that the number on her card represented money she could touch. She had no idea that within 72 hours, everything she trusted would collapse, not because the number was wrong, but because the number and the cash were never quite the same thing, and nobody had ever told her when the difference would matter. This video is for educational purposes only and does not constitute financial, investment, or legal advice. All figures, historical events, and legal references cited are drawn from documented public sources, and any estimates are indicated as such. Consult a qualified financial professional before making decisions about your assets. If this analysis changed how you think about where your savings actually live, consider subscribing. This channel exists to study the patterns most people only recognize in hindsight, because by the time the pattern is obvious, the window for preparation has already closed.